If you've ever built, fixed, or even just crafted something in India, chances are you've used a Pidilite product. They're the absolute giants behind legendary brands like Fevicol. Their business is a fortress, no doubt about it. But here's the big question for us today. Does having an unbreakable business automatically mean it's an unbreakable stock investment? Okay, let's get into it. Let's just start with one number that kind of says it all. 70%. That is Pidilite's mind-boggling market share in India's consumer adhesives market. I mean, think about that. They don't just lead the market. For millions of people, they are the market. It's a level of dominance that most companies can only dream of. And that really brings us to the heart of our explainer today. We know the company is a champion, but does that mean you should run out and buy its stock right now? Well, to figure that out, we've got to look at both sides of the coin, starting with all the reasons the market is absolutely in love with this company. So the argument for Pidilite, what we call the bull case, is built on a foundation that's just as solid as their adhesives. It's a story of incredible quality, stability, and a massive, massive competitive advantage. Now, to really understand Pidilite's power, we first have to talk about this idea of an economic moat. It sounds a little fancy, but it's a super simple concept. Just think of a castle's moat, that deep, wide ditch of water that protects it from invaders. In business, it's the same thing. It's whatever protects a company's profits from its competitors. And Pidilite's moat? Wow, it's not just one thing. It's like this triple-layer defense system. First, you've got that iconic brand power. Fevicol has an unbelievable 98% brand recall. It's just part of the culture. Second, their distribution network is just everywhere, reaching over 850,000 stores all across India. And third, they never stop innovating, pouring money into R&D. It is just incredibly hard for anyone else to even try to compete. So what happens when you have a moat that strong? Well, you get a financial report card that is pretty much flawless. I mean, check this out. The company is basically debt-free. Its profitability is fantastic, with a return on equity over 22%. On top of that, you've got strong margins, it's a cash-generating machine, and it has steady, reliable growth. From a financial point of view, it's about as safe as houses. Okay, so the business is a fortress, and the financials are pristine. What could possibly be the problem? There's got to be a catch, right? Well, the argument against the stock, what we call the bear case, isn't about the company itself. It's about the price, the very sticky price you have to pay to own a piece of it. And this quote from our source, Web Cornucopia Finance, just hits the nail on the head. The biggest risk here is that premium valuation. In plain English, the stock is expensive, and that high price doesn't leave you much room for error, or what investors call a margin of safety. So to understand just how expensive it is, we need to look at a key number, the P/E ratio. Don't worry, it's just a simple tool that compares the company's stock price to how much money it's making. A higher P/E usually means a stock is more expensive. So what does Pidilite's P/E look like? Well, right now, investors are paying over 58 times Pidilite's annual earnings for one share of its stock. Now, let's put that into perspective. The average for other companies in its sector is around 42. That's a pretty big gap. You are paying top dollar because, well, everyone knows it's a top-quality company. And beyond just that high price, there are a few other things to keep on your radar. The stuff Pidilite uses to make its products is linked to crude oil prices, which can be super volatile. Also, a huge piece of its business relies on the construction industry, which can go up and down. And, of course, you always have big global companies trying to steal a piece of the pie. So here we are. We have this absolutely fantastic business on one hand and a very, very expensive stock on the other. How do professional analysts take these two sides and figure out what to do? Well, what they do is they build these financial models to try and estimate what the stock should be worth based on all the money it's expected to make in the future. It's a process called a discounted cash flow analysis. They'll run a few different versions, a pessimistic or bear case, an optimistic bull case, and a realistic base case. And these are the results from the source report's analysis. So, in a downbeat scenario, the stock is worth about 2,200 rupees. If everything goes great, it could be worth 3,200. But the most important number here is that base case, the most likely outcome. It puts the fair value right around 2,850 rupees. And since the stock is trading right about there today, it kind of suggests there isn't a ton of immediate upside.
Okay, so after crunching all the numbers, analyzing that incredible moat, and weighing all the risks, what's the final verdict from the analysts at Web Cornucopia Finance?
This scorecard tells the whole story in one glance. Look at those amazing scores. Financial health, 8.5. Competitive position, 8.5. Management, 8.2. All fantastic. But then your eyes drift down to valuation, and it's a C minus, a 5.5. That one single factor is what's holding the stock back from being a slam dunk buy.
And that leads directly to the final recommendation: hold. So, what does that mean? Well, if you already own the stock, it's a great company to keep holding for the long run. But if you're thinking about buying in today, the advice is to wait, to hold off and hope for a better price, maybe if the whole market takes a dip.
So, the key takeaway from all of this is pretty simple. Pidilite is a phenomenal, high quality company. It has a competitive moat that's like a fortress. The problem is, the market already knows this, and the high stock price already has all of that quality baked right in. For a new investor, the issue isn't the business, it's the price tag. And that really leaves us with one final big question to think about. For a company that is so dominant, a true champion built to last for decades, is there ever a price that's really too high? Or is paying a premium for that kind of quality always the right move in the long run? That's a debate that lies at the very heart of investing.